Here's what you can look forward to on this episode of The Nice Guys on Business.
And so when you can show them that the business is built to sustain without the founder around, and that there's still blue ocean to exploit, there are still growth opportunities adjacent to wherever they're getting the business right now, buyers are going to pay up for that business. If, on the other hand, you appear to have already, gotten meaningful market share, no matter how good you are, if they can't see a path to, making 2.5 to 5 times their money, then no financial buyer is going to buy your business, right? So it's a certain amount of just transferable economics and repetition of those economics and the ability to sustain them when you leave.
My name is Marcus Decimus Meridius, commander of the armies of the North, general of the Felix Legions, loyal servant to the true emperor Marcus Aurelius, father to a murdered son, husband to a murdered wife. And I will have my vengeance, in this life or the next, against the nice guys on business. Go from where you are now to where you could be. Get expert tips to grow your business, to be more productive and more efficient, whether you're trying to build influence, grow your community, or make it rain. Best-selling author of Nice Guys Finish First, Doug Sandler, can lead the way. The Nice Guys on Business is produced by Turnkey Podcast Productions. Now, here's your host, Doug Sandler.
All right, Nice Guy community, let's find out what has changed since December of 2023. That was the last time that Kirk Michie was a guest on the Nice Guys on Business. Now, Kirk is the founder of Candor Advisors and has spent 30 plus years in the trenches of mergers and acquisitions, helping business owners and families navigate complex deals with clarity and with confidence. Now, Kirk knows what it takes to structure the right deal and avoid the wrong one. If you own a business or are acquisition curious, let's tune in. Kirk, welcome to the Nice Guys on Business. Welcome back, actually, to the Nice Guys on Business podcast.
Thanks, Doug. It's great to be back with you.
Yeah, happy to have you here. I want to talk about something that's really important. The Playful Podcast, your wife's podcast, is a top 10% globally ranked show in such a micro niche also. How does she do it? Can you stand the ego that must be going through her head as top 10%er?
Well, I will tell you that one of the things that you've no doubt learned about Christine is that she is enthusiastic about anything she is enthusiastic about at a degree that most of the rest of us, we're 2 gears short of that. We cannot, if most of us are driving a 5 or 6 speed, she's got an 8-speed transmission. She gets so fired up about it. Plus, she's so extraordinarily connected within her field that if you or I could get, Bob Iger and Brene Brown and Rich Roll and Tony Robbins in the same week, that would be like some of the podcast guests you see her pull in her field. It's just extraordinary.
It is amazing the caliber of the guests that she gets. And I misspoke. She's not a top 10%. She's a top 5%. So wow. Sorry, Christine, amazing. If you're listening to this. So she is doing awesome. And thank you for referring her to me many, many years ago. And we've had a great relationship since. So Nice Guy community, see that the relationships, whether they're direct or indirect, they always seem to pay off. But I want to have Kirk back on the show because so much has changed just in technology and maybe the old school mentality of when is it time to think about, selling a business and all of that. I'd love to hear from you, maybe some of the old school stuff. What are some of the things that founders and CEOs and organizational owners, what is some of the stuff that they're doing right? Because I don't want to start in a bad spot. What are they doing that's right with their business?
Well, look, the best way for a transaction advisor to maximize, price, terms, and control of legacy for a selling founder is to start with a great business. And if a great business has, really transferable economics and the ability to survive the founder, not have the founder leaving be a risk factor, then the transaction advisor can maximize things, kind of all other things constant. So none of that has changed, no matter what the technology is. Buyers are looking for, kind of that sweet spot of as little CapEx and cyclicality as possible, as much recurring revenue as possible, as many loyal customers, and as much of kind of a moat or differentiation around the business. So to think about it like, the buyers, no matter what the business is, want to buy a business that acts like a software business. no matter what it is, whether
right.
it's a dry cleaner or
right.
a construction manufacturer, they want it to act like a software business. So that piece hasn't changed at all. Some of the other kind of contributing factors, they've changed a lot.
You know, I think about everything that I was in my previous life, my previous career, which I had for 30 plus years as a bar mitzvah MC, and being up in front of that crowd and running those 2,100 bar mitzvahs over the years that I had done that. I think about without DJ Doug, the business would have failed, you know, because people were hiring DJ Doug. And when I started to build my entertainment business, and we had 9 or 10 other DJs that were working for us, then I discovered, hey, I don't want to make this about the personality. I want to make this about the business model. I want to make sure we're exceeding expectations. We're returning our customers' phone calls. We have the same process for onboarding a client, but we add the personality of the entertainer in there as well. I took all of that and brought that over to Turnkey, which made it like, I don't want to be the single point of failure. You know, a new owner wants to come in and buy us. I don't want anybody to say, well, we have to have it, but Doug's got to be the reason, you know, Doug's got to stay forever and we need him. And so we built this business with great systems, documented the crap out of everything, created a revenue model, which was subscription based. You know, it's like all the stuff that I didn't do in my DJ business.
Yeah.
And I think I learned that I wanted it to be easier for me as the owner. Are owners today, are they taking too much responsibility, and are they doing too many things themselves and not delegating or handing off enough responsibility to others? What's your spin on that as somebody comes to you and says, hey, I'm interested in thinking about selling my business? What do you look at when it comes to that stuff?
Well, I don't know how much that part has changed, because that part's so much behavioral. And, you know, a lot of, I think like in some ways we get more knowledgeable. I don't know about smarter, but we don't really get any emotionally smarter over time. If we did, then you know, therapists and you know, psychologists and psychiatrists would not continue to boom. There wouldn't be billions of dollars invested in like meditation and you know, and behavioral health apps, right? So we don't get behaviorally any better. And a self-focused CEO or founder who has what we call Ozzy Osbourne syndrome. You remember, you know, Crazy Train? It starts with the drum beat and the I, right? That echoing I. When we're talking to a founder and the whole conversation is, I did this and I do that and I brought in this and I'm the most connected to that. Our viewpoint is we're probably not the right transaction advisor, because we're only going to work on a couple of deals a year. And the only way for me to convey to a buyer that that person's not important is to come up with a covenant between he and I where he doesn't say much of anything in the meetings with the buyers.
Yes.
And that he sits at the back end of the table and we put somebody from his organization towards the front end of the table and let them run the charge. And we have had those scenarios before. We have had cases where, you know, you've got, you know, so I'm not a behavioral health professional, but somebody who felt like a narcissistic founder who just could not do, you know, in those cases, the buyers see it as a risk factor, and there are so many deals out there to do that they just move on.
Yeah, I completely understand. But coming along with the territory of being a CEO or a founder also is sometimes the ego that's attached to it, and especially if that was a family business, let's say, where it was handed to that next, you know, as a legacy business. A lot of times, look, I learned a lot of lessons in my first business, enough to know that when I start the second business, I don't want to be that guy. I don't even want to be in the room. You know, if you want to take care of it, that would be fine.
Right.
But I see that could be potentially a problem. But it's also got to fit your culture though too. And your environment is, hey, look, you're hiring me because I'm the expert in helping you through this transition. Let me do my job. Do you ever feel like you have to say that over and over again? Just let me do my job.
Well, we kind of pre-screen for it. So it doesn't usually have to be a second or third conversation, because the way we built our business, we have so much inbound demand for what we do that we kind of get to pick and choose. This will give you a little bit of a window in this crunchy Californian's, you know, kind of way of navigating things. But I spend time with my therapist and my advisory board talking about how we can say no to people and get them to a different advisor or provide them with a resource. So we don't really have to wrestle with, kind of a founder going rogue on us because we're pre-selecting for it. But there are certain businesses that are so connected to the founder that there's no way to, kind of cut them apart. Like, I mentioned Tony Robbins earlier. Now, I understand that Tony Robbins owns something like 100 companies that generate like, $9 billion a year in revenue.
Wow. Yeah.
Now that's like a Tony Robbins assertion. So I don't like, and they're all private. So, but let's take him at his word for a second. At the end of the day, if he's not the dancing bear on stage, Robbins Research International is probably not that worth that much money. I don't know how many of us would be willing to go to his Date with Destiny $30,000 week-long thing if he's not the guy who's doing it.
Right.
So I don't know. I mean, it's a high quality problem, but I don't know that that's really a sellable asset. And there are versions of that. But I mean, look, if you built a manufacturing business that does, $2-3 million of clean, EBITDA or cash flow on 20 million of sales, and you've got a good controller and a good either chief operating officer or chief revenue officer, and you have relationships with all of your most important customers, suppliers, and vendors, but you're not the only one that has the relationships,
right? You
can easily move on.
Right.
In fact, in those cases, the founder's probably not even as important to the relationships as he or she may think they are.
Right. No, I completely understand that. And as you talk to, I remember anybody early on in our turnkey business, anybody with a checkbook was a potential client, and we found that was not a good model. It was horrible. I mean, we were able to get revenue, but it was revenue for a client that would come on board and quit after 12 episodes. We want the client that wants to stay on board for 24 months, 36 months, 5 years, the entire length of their podcast. They would never even consider looking outside when it comes to that. What are some of those things that you find that companies are doing now that are key saleable assets? It's not just the bottom line, but the characteristics, organizational size, maybe dollars, environment. What's good? You mentioned a couple of those things earlier. Yeah.
So generally speaking, the more systematic their financials are, the more repeatable their revenue. So we think of businesses in terms of annual recurring revenue. That's like a software business. And then they do other calculations like net recurring revenue, like how much churn do you have, customers leaving, logo retention, how many customers are kind of upscaling or downscaling. So there are a couple of calculations there, but we kind of work off of that framework, not because we do so many software deals, but because that's how buyers think.
Right.
And so then we also look at, so there's annual recurring revenue that's highly recurring. We look at annual recurring revenue that's highly reoccurring, meaning you've got a client or customer who's been with you for 15 years. 1 year they do 75,000. The next year they do 338,000. They've got a $1.2 million a year and then a $15,000 year, but it's highly reoccurring.
Right.
And then there's also highly reoccurring customers, right? Like maybe the business is more project-based, like say a construction business might be project-based, and they may do everything in hospitality or restaurants. And their projects have a lot of revenue when they're happening and a lot of costs when they're happening, and then they end. Right. And so maybe you do $25 or $50 million a year of revenue, and that's been happening for a long, long time, but it's always from different customers. How many of those customers continue to repeat? Right. So the more repetitive either the revenues or the customers are, that's like thing one. All buyers want that. Right. Because they want to get, even though they say they want to add their capital, their strategic guidance, their operating expertise, and their relationships, the reality is they're not operators. None of the buyers are actually operators. And I'll even say that the people that lead the charge from the strategic buyers aren't really operators. They may have operators in their company, but especially the private equity firms, they want the businesses to run like they're running and not have to get too involved, right? They say they're going to get involved, but they usually don't add that much value. And so when you can show them that the business is built to sustain without the founder around, and that there's still blue ocean to exploit. There are still growth opportunities adjacent to wherever they're getting the business right now, buyers are going to pay up for that business. If, on the other hand, you appear to have already, gotten meaningful market share, no matter how good you are, if they can't see a path to, making 2.5 to 5 times their money, then no financial buyer is going to buy your business, right? So it's a certain amount of just transferable economics and repetition of those economics and the ability to sustain them when you leave.
I'm sure that there's a number of potential business owners, CEOs, founders that come to you that are mentally in a position to be ready to sell, but you can just tell by looking at their books or looking at their process or their systems that they're probably a couple of years away from that happening. Right. What's that conversation generally look like with you? How does that happen?
Yeah, so this is one of the things we've kind of worked on over time, because what I found, Doug, was that we were succeeding right away. We did $1 billion worth of transactions in our first 4.5 years after I started the firm. And so we were doing a lot better than we expected to, and we were doing a lot larger transactions. And what we found was that, transactional expertise is like table stakes in our world, but our advisory model, the way that I'm more Brene Brown, Tony Robbins than I am, Wall Street investment banker.
Yeah.
That resonates with founders who don't want to hear a lot of, terminology and acronyms and, stuff like that. So, but what we found too was that, when somebody would come to us with, say, a really cool, what we would call a lifestyle business, a business that provides somebody with a great living, but it's not obvious to a buyer that they could meaningfully scale it because it's not quite big enough for them to do anything with, that even if they made it 5 times as big, it wouldn't be a good enough outcome. So those conversations are around the idea that we can, we could probably find, or you could probably find, a buyer for this business. It's probably going to be somewhere in the neighborhood of 2 or 3 and maybe as much as 5 times your EBITDA. So, there are those buyers out there. They're mostly search funds or entrepreneurs who are looking to buy another business, or, but to get the attraction of the meaningful financial buyers who have the $2 trillion worth of capital to invest, to be able to pay up, to get the strategic buyers to get them to pay more, you're probably going to have at least $2 million worth of EBITDA. Now, that number has come down a little bit. Some of the private equity groups are doing more transactions and trying to do more proprietary deal flow. And so they're doing deals down as low as $1 million of EBITDA, which I say as low as $1 million of EBITDA. If you or I owned $1 million EBITDA business, that means we're taking home $500,000 a year. That's a big business for one person to own. Right. But, generally speaking, what we talk to them about, and we have productized something that in 3 months kind of gets them on a trajectory, and then we release them and they come back to us 12 or 18 months later for kind of a progress update to see, whether the go-to-market analysis is there. And that involves what valuation looks like right now, who the buyer set would be if they went to market right now, what kind of shape a data room, like all the things that a buyer would want to look at, is in, and whether they've got work to do there. And then we give them a trajectory plan. Right. So for a while, we weren't able to help them at all as investment bankers. And then we decided, there's a way for us to help them. And there's also a way for us to dimension the cost of doing that so that it's got high ROI for them. And look, we're not in this as a nonprofit. That's my wife's side of the wall. We make decent money, sort of our minimum retainer on each one of those clients, but we tell them it's only going to be 3 months in length. And then you won't need us. You'll just want to go execute for the next 12 or 18 months and then come back and talk to us. So we're developing long-term pipeline when we're doing that work. We're developing some trust with those entrepreneurs, and we're helping more people. That way we can, because if my next $1 billion worth of transactions would be $20-50 million deals as opposed to 2 $500 million deals, I'd be much happier with the former, even though it would take a lot more work. I want to get more founders to great outcomes.
How are you feeling? Like, is technology impacting your business at all? Does it make it easier for you? I looked at it early when AI was really starting in its very. I mean, it's still in its infancy, but AI was just beginning to rear its head, and everybody said, "Well, nobody's going to need a podcast producer anymore because they're just going to feed all their audio into to this machine, and it's going to output all the edited content." And I'm like, no, it's just going to make my job easier. It's going to make my job easier so that I can deliver more to my clients. And that's been the case. How about in your business? How has technology affected you?
Yeah, so I think we've been kind of an early mover on using AI for a lot of different parts of our business. I've told lots and lots of people that I have no interest in scaling my company, but levering it is really interesting to me. So, one of the ways we do that is like, the first thing we do on any new project is the initial research is all done through Perplexity or ChatGPT on what valuation and potential buyer set looks like. And it gives us all the links we need. It would go all the way to creating a confidential information memorandum, a teaser, an NDA. We don't take it that far, but we take that initial piece and then we give it to our research team. We've got 8 people in India and 2 here. That work together to kind of develop and narrow that buyer set and try and get best fit analysis on what valuation looks like based on precedent transactions. And so much of that is database and technology. And then, a lot of the, call it the framework of a confidential information memorandum, which really hasn't changed over time, like introduce the opportunity, show the timeline, talk about the current business, talk about the growth opportunities, present the financials. Every deck you've ever looked at is those things, right? So that piece is only easier and easier with AI and having a partner that's a little less expensive than somebody I might pay onshore. And then the last piece I'll add is that we're working with a couple of different software providers in beta form to try and get to where in a data room, there might be 1,000, 5,000 different pages of documents, every contract with every vendor, supplier, customer, all the employee agreements, all the litigation history, if any, kind of every single piece of paper that you're going to buy when you buy a company, essentially in total. Of that, there are a lot of privacy or confidentiality agreements. There are rights of first refusal. There are documents that need to be effectively executed, meaning both sides have signed them. There are columns of numbers in the spreadsheets that need to foot. They need to tabulate correctly. So right now, either some overworked grunt at an investment bank is going through all that stuff. And either dying on the job or quitting early.
Right.
Or an $800 an hour associate at a big law firm is going through every single one of those client documents, and it's costing $75,000 to $150,000 for a guy who's selling a business that's going to sell for $10, $12 million.
Yep.
Or somebody figures out how to use AI to scan all those things, look for signatures, look for rights of first refusal, look for, like, you can train it that way. You can use optical character recognition that way. And so, we can't wait for that to happen. And we started reaching out to some of the tech providers that we work with and said, are you doing anything on this? And in 2 cases, we got, 2 of them to start working on it. So,
that's very cool.
Yeah. That'll be neat because the due diligence process is not only invasive and accusatory to the selling founder, but it's way too time consuming. I understand why the buyer needs to see everything. What I don't quite understand is why it needs to take so long. So we can't wait for that to accelerate.
Yeah, that's cool. That sounds like that's a big in the plus column for AI for your business.
For sure.
You have something on your website. I don't remember the exact wording, so you'll have to help remind me if you remember it, because it may have been a while since you've been on your own website, so I don't know. You say something like full-time predators, part-time prey. Like the buyers are the founders are part-time prey, and the advisors and everybody that's doing the job other than the job you're doing, of course, are the full-time predators. Can you explain that? Because I think that it made an impact. Just that one line, I'm like, oh my God, totally get it.
Well, the phrasing specifically is the buyer of your business is a full-time predator. and you're part-time prey. You need to offer up.
Yeah,
That's right.
exactly.
I have a U.S. Patent and Trademark Office number on that phrase as it relates to the merger and acquisition world. So, however, we're starting to see that creep in. In fact, I was listening to a podcast where Scott Galloway was talking about the M&A business, and he talked about predatory buyers. Now, I don't have so much ego that I think that Scott's ever seen my website. But I felt pretty good about it. If imitation is the sincerest form of flattery, we have people that actually think they know who we're talking about. And there is no one buyer we're talking about in that case. There's not even in one type of buyer. But what I mean by that is that if you're selling, let's say you've been building your company for a decade or 4 decades or 3 generations, and it's time to sell. You're going to sell, no matter how long your history is, on a multiple of your trailing 12 months or last full year's worth of revenue or EBITDA.
Right.
The buyer is going to put the deal together, partly structured on the next 12 to 18 months, which you'll no longer control. You won't even control your P&L if you do a majority sale. So you might not get some of those proceeds. So no matter how long you've been building that business, you walk right into that buzzsaw.
Right.
And you might think that these are nice people and it's a heads up transaction. I've negotiated deals before, and so I'm willing to kind of walk into this thing. And the thing you got to know is that wet-nosed 22-year-old associate working at the private equity firm has worked on more deals in the last 4 weeks than the savviest founder will go through in their entire lifetime.
Right. Right.
And there's nothing the private equity buyer likes more than an unrepresented founder, a founder that's not using true M&A counsel. They're just using their college buddy who knows how to do contracts, and they're not using an investment banker at all because they don't want to give up, any percent of the deal. Why do I need that? I can negotiate it myself. And they won't understand that there are probably on a mid 8-figure deal, there's probably $3 to $5 million worth of stuff they're going to miss, maybe as much as 10 to 20, depending on what the structure looks like. On a 9-figure deal, there's 10 or $15 million worth of stuff that they're going to kiss goodbye.
Wow.
And they're going to miss it entirely because afterwards, when they're recounting their story to their IPO or WPO or their Vistage group, when they come back and talk about their deal, they're going to say, I'd never agree again to an earnout, or I would only do this if I would only roll equity if I was going to see their track record, or I would only take back a seller note if I knew that I was higher on the capital stack than the bank or the firm's management fees. They don't know that stuff going in, and so they won't negotiate for it. And I totally get it. You don't want to get $20 million and give up, 500,000-600,000 of it if you don't have a really clear idea what you're paying for. But the challenge is you're going to give up multiples of that in deal structure.
Absolutely. Totally get it. 100% understand the value of bringing in a professional. It's one of those things that you could launch your own podcast, or you could let somebody that's done it a few hundred times launch a podcast for you. So wouldn't it make more sense that's not your zone of genius. It's Kirk's zone of genius. Let he and his partners work this out for you.
Yeah.
You probably have, I would think, a pretty extensive network. Do you ever run into the same buyers, same sellers? Do you have an opportunity to work with the same people over and over again?
Yeah, we do. So we have, specifically, we have the Candor Advisors National Network, which has all of the investment banks that we have referral relationships with. If we're too busy or we don't have the right subject matter expertise, we want to make sure we get that founder into the right hands. So they are on our website. You don't get handcuffed to our website. You can leave our website and look at their website. We can make the introduction, or you can seek them out on your own. We have the same thing for the M&A attorneys we work with, for the accounting professionals who do kind of the quality of earnings work to get to that EBITDA number. We have wealth advisors that we highly recommend. And beyond that Candor Advisors National Network, there are a number of folks, all of whom are in that network or are just kind of one click away in our realm of acquaintance that we've worked with before or have really strong professional relationships with. So we got retained by a company today that's on a fast track. They've already got a buyer that's interested, and they're responding to an unsolicited offer. We do a lot of that kind of work because we have a way of making sure that without blowing the deal, they can maximize certain considerations, even without having to kind of open up the process and make it competitive.
Right.
And the guy asked me about an M&A attorney who's in Southern California who, he was wondering if I'd worked with him before. I said, I can tell you his golf handicap, where he belongs. I can tell you he went to Harvard undergrad and Harvard Law School. I can tell you his ethnicity. I can tell you what his wife does for a living. And I would love to work with him on another deal.
That is awesome.
It was pretty fun. It was pretty fun.
Well, it makes life a lot more enjoyable for all parties if you don't enter the negotiations from an adversarial standpoint. I would have to think, and I would think that a lot of times there is a lot of high pressure moments that could be smoothed over by just having a solid relationship before entering into the transaction.
Absolutely right. One of the early litmus tests is if you're going to market, you want to see what kind of markup you get on the non-disclosure agreements and non-circumvention agreements. If buyers mark that up really, really heavily, it tells you something about their personality. It tells you something about their controlling tendencies. So all of it's information if you don't react to it. And then, look, the person in our role, at different points in the transaction or different points leading up to the transaction, will have to play kind of a designated asshole. Every once in a while,
understood.
I just got to get on the phone with the buyer and say, hey, look, this is not working for us. Or, this needs to be changed, or we need you guys to do something different, right? And when that's happening, what we found, Doug, is that even if what you're saying isn't likable, if you're likable and it goes okay, and if you're not uncomfortable bringing up hard subjects, and so one of the things we do to make sure that we're good at this, we bring up every hard subject early, right? So oftentimes, investment banks will send over an engagement agreement to a prospective client, and they will not have called out the provisions in there like, we need you to make representations and warranties to us. We need you to indemnify us. Here's what our fee's going to be. Here's what it's going to be if it's this.
Right.
They win that mandate. They send this thing over blind. The client opens it up, or the client's attorney opens it up and starts marking up the hell out of it. And the client is bothered by this.
Right.
We bring it up right on the Zoom call or in person. And we actually talk to them about the dollar amount it's going to be. And we want to have that conversation early on to make sure they understand the value that we're adding. I think most people don't want to have that conversation. And I think a lot of our clients find out that if we're that comfortable with having those conversations with them at this point of inflection, we'll be good at having them with the buyer when it gets to a challenging point on working capital or a escrow amount or something like that.
What are some of the characteristics of the ideal founder or seller in your case? Somebody that wants to come and work with you. I know it sounds like you have a pretty decent waiting list, or at least a decent curve of somebody coming into your firm. So tell me what that looks like.
Yeah. So it's really about what I would call founder dynamics. So first, we'll only work with selling founders, not the hired CEO, not somebody who's performing for the selling founder, but the founder. There are one or two exceptions we've made where the founder was going to be involved, but the CEO was going to be our lead on the deal. That'll work for us. We want to know the person who's got the why behind the selling. We want to know the person who's been taking the existential risk of the business surviving and making payroll for the entire time. That's the person we want to be working with. So in that sense, it doesn't matter what sector it's in. I mean, we've done recycling deals, cannabis services deals, software deals, big healthcare services and life science deals. So, but it's that founder dynamic, and it's the collaborative piece. We want to work with people. Look, we're going to end up spending in a full process 4 to 9 months, in some cases 11 or 12 months if the deal goes sideways at some point. We're going to be spending a lot of time with that person. We've got to like them, and they've got to like us. Yeah. So there has to be a covenant formed early on, and it's usually good to do it before the engagement letter that says, look, I'm going to ask you to do a bunch of stuff. I promise you, if you do that stuff, I will get you to where you want to go. But it's collaborative. You can't, like, I understand you feel like you're hiring a vendor, but if we can't have a different kind of relationship than that, probably not going to work for us. But I can recommend 25 different investment bankers who, for that kind of fee, they're happy if you treat them like crap the whole time. They'll get over it, right? They'll buy therapy.
They'll work with your CEO or your controller or your COO.
Whomever.
I won't, though.
Whomever. And I mean, like, for me, it's not a, it's not a kind of a caste system thing. It's more, maybe this is right, but I think I'm kind of an empath, and I can only I connect with the feelings that a founder has when they're thinking about selling. And I don't think that somebody who doesn't, kind of connect in that way is an ideal client for me. But for the ones that do, I think I'm as good or better than anybody.
Well, I love what you said also. You like to know that this was the one whose head was on the block when it came to making payroll during COVID, or something,
Amen.
Something like that. When you have that person that's emotionally involved in their business, and that oftentimes, while a CEO is a great person to lead an organization, they don't necessarily have the same risk involved in the business as that founder did.
They don't, and they're, it's not that they can't be good at it. Look, I mean, I'm sure that, the CEO of Paramount Pictures has been more involved in the discussion about selling that business than Sherry Redstone, the owner.
Yeah,
the daughter of, kind of the founder of that whole thing. But I will tell you that every time that deal's gone off track, it's because the investment bankers, lawyers, the CEO, all the principals were involved. They got everything buttoned up. And then Sherry changed her mind overnight.
Right.
I can also tell you that the reason that the only binding LOI I think I've ever heard of in my time in the business was the Twitter deal, Elon Musk buying Twitter. And in that case, you had a deal where the board of directors, Twitter, contrary to Jack Dorsey and his endorsement of Elon Musk's buyout, the board of directors of Twitter, essentially had to force the transaction based on the binding LOI that Elon submitted. And so rarely will you get a case where the hired people, can absolutely say with certainty that they can, get the deal across the line. And for us, because we're only going to work on 2 or 3 deals a year, we just can't take the risk that, the CEO maybe at the 11th hour decides that he ought to get, 5% of the proceeds because he's carried this thing across the line. And he or she holds up the deal when we've all been working, days and nights to get it to the tape. But the founder's the one who, if I get a call the night before the deal's supposed to close, and this has happened now 3 times, where the founder said, I don't think it's enough, or I don't really like these people. We walk them through the exercise of going back and saying, look, I'll be the bad guy. I will call the buyer, and I will call their counsel, and I will call the investment banker on the other side and tell them we're not going to do the deal. Let's walk through what we're giving up. Let's walk through the opportunities ahead of us, and let's make sure. And then ultimately it's going to be your decision. And look, 7 figures hung in the balance for us on more than one occasion.
Yep.
But my feeling there is, I take my cues from Marcus Aurelius. Don't argue about what a good man should be. Be one.
Be one. Right? Exactly.
Be one. Right. So at that inflection point, if I'm not willing to say, hey, look, if my goal is to get founders to better outcomes, and we're the night before a big wire transfer is going to hit your account, and you're saying, I don't think this is right for me, it is absolutely my job to, kind of talk to you about what you're thinking there, and then carry through whatever your preferences are to the buyers.
Well, I would hope that doesn't happen on a regular basis, because that's enough to drive a guy to drinking some serious. But I'm sure it has happened. Just like with everything, you never want to get that call from the client that says, "Look, I don't think this is the right deal," but you got to deal with it when it does happen.
Right. Absolutely. And I'll tell you that, part of my career, I was a financial advisor. And one of the easiest ways to build rapport with somebody who's investing proceeds of sale is to say, how long did it take you before you hated your buyer? So I can tell you that entrepreneurs generally do not make great employees. And what ends up happening is either the private equity firm or the strategic buyer, essentially puts them in a reporting line. And it's not usually going to work out that well. It's part of the reason we, where possible, negotiate consulting agreements for founders, never employment agreements. It's part of why we tell the founders right up front, no matter how great this is going to feel when the corks are popping in the closing dinner, there's a period of time in which you're going to start to dislike them. You're going to start to bridle at getting told what to do. It's even going to be worse when it's not the principals telling you what to do, but it's some like downline manager who couldn't carry your gym bag into an important meeting, and they're telling you what to do. So just prepare for that. Right?
Understood. Well, as always, great conversation. Is there anything that I'm missing that I should be asking you that my audience, my community should know more about what you do and how you do it?
I don't think more about what we do and how we do it, but I will tell you this is a particularly opportune time for businesses to go to market that have solid economics, who are not exposed to any kind of tariff uncertainty or supply chain risk. And, it seems like an obvious one, but what has happened is there were a lot of those deals moving forward where investment bankers and buyers were all lined up and deals were ready to happen. And they went pencils down as soon as the tariff saber rattling started happening. And they have not resumed activity. What that meant, though, was because there's $2 trillion worth of private equity and private debt capital that needs to go to work somewhere. It's got a burning fuse, Doug. Those people have a 2 to 3 year investment window where they have to give their money back to their limited partners. So they went almost a year of not being able to do deals. They were fired up to get them done. And then the tariff uncertainty happened. So all the professional services businesses, the software businesses, the landscape maintenance businesses, the pool cleaning businesses, the engineering services businesses, the construction services businesses, like all of those kind of truck and clipboard businesses, and, accounting firms and wealth management firms, all of those businesses all of a sudden got a big spotlight put on them.
I would even say even the podcast production businesses. I mean, I can't tell you how many times that I go to my email box, and there is a not an offer, but there's somebody that's interested in taking a look at the business. And I know if I'd slide my decimal point maybe a couple of spots to the right, we probably have the cojones to make it happen. But for now, we're going to stay in the podcast production business, at least for a few more years. We really enjoy doing this.
Excellent.
Well, great talking to you, Kurt. If anybody wants to get more information about how you do what you do, where's the best spot for them to get that?
Yeah, CANDOR-ADVISORS.com, CandorAdvisors.com.
We'll make sure we put a link in the show notes for that, and there will be a bunch of spots for you to take a look in the show notes for you for relevant information about today's episode. Kirk, thanks for being here. Thanks for being on the show.
Thanks, Doug. Appreciate it.
Hey, Nice Guy community, never underestimate the power of nice. Again, special thanks to Kirk Michie. All of his information about Candor Advisors will be right there in the show notes. Steve O'Brien, go ahead and take us out of here.
Friday advice and Tuesday interviews with people far more interesting than they are. Fill up your week with the Nice Guys. Have fun storming the castle.